Everyone except maybe the smallest, simplest business in the world needs to have some type of vendor activity. Now, with that said, even a small home-based business probably should be working with vendors. Even if they're not writing off utility payments because they have an in-home business, they need to have at least something that they're buying for their business on behalf of their business that should be expensed. For more traditional or larger businesses, we of course have lots of vendors, people who provide the overhead and services utilities that we normally use. Most businesses also have some type of product or service that they sell, and vendors provide this. In this chapter, we're going to go through the process of getting ready to sell. We'll enter services and products that we ultimately will sell to our customers to make money. With inventory, we need to know how to order and receive inventory, as well as how to make adjustments to our inventory. In addition, we'll also learn how to make something called an assembly. So if you buy raw products or if you package things together, you'll be able to create those and have them ready to sell on your invoices as well. It's a very exciting process getting ready to put everything together that you need in order to start the sales process. Whether you are a product-based business, a service-based business, or even a not-for-profit, you're going to need to work with the inventory process. The first thing you'll need to do is to set up inventory-related accounts. Now, this is probably already at least started for you. When you use the wizard or if someone sets up your Peachtree account, you should have some type of inventory-related accounts in place. But you should take a look and make sure they're appropriate and see if you need to add any sub-accounts. The next step would be to set your vendor and inventory defaults. Setting defaults is usually going to be one of the first steps that you take in anything that you work with in Peachtree. This will ensure that you have consistency and that you don't have to reset the same things over and over every time you work with a new vendor or a new inventory item. Then the fun begins. Now you get to actually start adding items. If you are a product-based company, these of course will be the things that you sell. If you're a service-based company, you will need to add your services. So when I talk about items, I'm really talking about services as well as products. If you are a product-based company, then we have to go through the next few steps. You need to order the items, then you'll receive the items, and then, unfortunately, you also have to eventually pay for the items. As time progresses, you probably will also need to do physical inventory. Unfortunately, things aren't always perfect, and so the computer says we should have a certain number of something, but when we actually go to the shelf and count, we don't have that number. It could be because of theft, it could be because of spoilage, or maybe something broke, but in any event, you do have to go and adjust the inventory levels at a fairly regular basis, certainly before the end of year and taxes. Now, if you're working with services, you're only going to do the first three parts: setting up the accounts, adding the defaults, and then adding the individual services that you sell. The last several steps are going to be for product-based only, where you actually have to order things. So keep this in mind as you work through, and remember that after you have all of your inventory or services established, you won't necessarily have to go through the first steps again. You'll pick and choose different parts of these. For example, you may receive items and then wait 30 days to pay for them. Those are all of the things that we'll talk about in this particular chapter. When we talk about the inventory-related accounts, one of those types of accounts are called inventory asset accounts. Now, when you create this, you have to have an opening balance. If you are a brand new company, you have zero inventory, then you don't have an opening balance, it's zero. But if you had an existing inventory, you're going to go ahead and add that. For example, if you had $10,000 worth of product sitting on your shelf when you started using Peachtree, you need to add that $10,000 because it's an asset for your company. The balance will then increase when you make purchases, and it will decrease when you make sales. If you have any losses due to theft, damage, or those unexplained differences between the physical count and the books, that's known as shrinkage, that's going to also modify the balance. That's one of those things that doesn't count as an expense or a sale per se, but it does need to be accounted for to keep the number straight. Physical inventory, as I said, should be done periodically. How often you do that is up to you. Some small businesses just do it once a year when they get ready to close out. Others will do it quarterly, some people even monthly. The thing is that you just need to be consistent. And if you ever think that the books are wrong or that they are different from what's on the actual shelf, a physical inventory may be in store, even if it's not exactly time to do it. Remember that inventory is kept as a current asset because generally we expect to convert it to cash within a year. Most people don't expect to hold inventory for 3 or 4 or 5 years. If necessary, and if you want to be detailed, you can also set up a parent inventory account. Then you can use sub-accounts to work with detailed item categories. You could do that for different types of items you sell or different categories. Sometimes smaller businesses never really think about how to cost their inventory. Now, it would be great if in the world our prices never changed. We always got to purchase our widgets for $1 and the price never went up and never went down, and we always sold them for $4. But the fact is that's not what happens. Over time, prices change. The method that you choose of inventory costing affects the balances of the inventory, the COGS account, and even your gross and net profits. Peachtree actually supports 3 methods, which is one of the difference between Peachtree and some other accounting. For example, QuickBooks. QuickBooks only supports averaging. Peachtree supports 3 different ones: first in, first out, last in, first out, and average. Now, if you talk to anybody in accounting, they will tell you that there are probably pros and cons either way. But the fact is that if prices rise, so if your inventory is costing you more to purchase, then first in, first out is going to yield larger ending inventory, smaller cost of goods sold, and a higher profit. If you think about that a little bit, it makes sense because you bought them initially cheaper and you sold those cheaper items first. Of course, the opposite would be true if you used last in, first out. And averaging just averages everything across the board. Again, this is probably something that you want to speak to an accountant about if you're not sure which costing method you want to use. There are just a couple of calculations when it comes to inventory, and they kind of make sense if we think about them. Fortunately, Peachtree does all of this work for us. If we take an ending inventory, for example, end of year, and we multiply that by the cost per item, then we're going to get our inventory value. We have to think back to our costing. If we're averaging and we have 10 items and the average cost was $10 each, then our ending inventory value is $100. It gets a little bit trickier when we do cost per item when we're using the first in, first out or last in, first out, because then our prices are going to be different. Again, this is where Peachtree really helps us because it will keep track of which items we purchased at which price and which ones have been sold, as well as which ones we're still retaining. Another calculation is to take your beginning inventory balance, for example, when you start your company, add in your purchases, subtract your sales, and subtract that shrinkage, and that will give you the total number of items in inventory asset times the cost per item. So again, these make sense if we think about them, and they're working in the background all the time in Peachtree as we do different types of transactions. Well, we talked about the inventory asset account. What about the inventory expense account? Because we know, of course, we have to have both sides of the equation. Well, this is our COGS, or cost of goods sold account, and it's modified every time a sale occurs. It calculates the cost of the item to the company and decreases the inventory account value by that amount. COGS appears on the P&L, or the profit and loss, and it calculates the company's gross profit. If you haven't ever had gross profit defined, that basically is what was the cost to sell an item, including its purchase price, as opposed to what we sold it for. So if I purchased an item for $25 and I was able to sell it for $100 and there was no other manufacturing or assembly required, then my gross profit would be $75. Gross profit is different from net profit because, of course, what hasn't been taken into account with the gross profit calculation is that usually we can't just buy and sell stuff. We have things like overhead. We're paying utility bills, maybe telephone, internet access. Maybe we have to pay personnel to actually sell the item. Those are the types of things that then take the gross profit and decrease it to get our net profit, which really overall is the calculation that counts. Gross profit can look really good, but if you have really high overhead, you may be losing money. When we talk about the income accounts then, remember that sales are going to increase the sales income account. It's going to either increase the cash or receivables. So if I sell a product for $100 and somebody gives me a $100 bill at that time, then that's going to increase the cash account by $100. If they take the product and I'm going to send them an invoice to be paid in net 30, then that $100 goes into the receivables account because I haven't been paid for it yet. These types of transactions can be recorded in a single account or broken down into sub-accounts. Now I could have part cash and part receivables, but this also means that I can keep detailed accounts. For example, in what I do, I keep track of what types of things I have as far as income when it comes to classroom training versus private training versus consulting versus instructional design. They're all income, but I break them down into different types so I can track what we're making and from which type of service. Sales are also reported on the P&L statement.